I launched Manhattan Street Capital because I believe that online investing as a category is gradually going to replace a lot of the methods that have been used in the past, and that it'll be more efficient than those. And it certainly provides already many small businesses options they never had before to raise capital in a viable way, whilst not losing control and not experiencing excessive dilution. Manhattan Street Capital has been in place since I started it about 6.25 years ago, just before Reg A Plus was live. And Reg A Plus has been our specialty since then for a lot of reasons. We are a funding platform and advisory service where we help companies figure out if they should use online investing, and if they should, what method. We innovate, we are selective who we work with, we add value. We're, I would say, a boutique. Our approach is not to have as many offerings as we can, but it is to have as many, not as many, is to have very high quality companies that we can succeed with in raising capital, and where the investors will be celebrating later that they saw this company through our efforts, and that they invested because it's turned out to be a marvelous deal. So those are the two objectives, and everything we do is secondary to those two goals. The level and quality of companies that have been approaching us just gets better and better and more exciting, and I'm feeling extremely fortunate that is taking place. It's really wonderful. Okay, I'll mention the disclaimer next, and then I will introduce Naif and review the agenda. So Naif Hajjar is here with us today. Naif is a very experienced guy in investing. He's worked in merchant banking and in investment banking with sizable firms, and is a highly ethical, straightforward, great businessman, which I don't say lightly. I like working with him. He and another chap did the Impossible Foods offering with us about a year ago, a little more than a year ago, which was very successful. And that was where I got to know Naif best, because I'd already met him some years ago. You know, there's a lot of people in this business that I got to know years ago that gradually I get to know better as we go and do things together. Anyway, Naif's a great guy. And he and his partner have put together the Get Helpful Fund. We'll get into that later as a part of this context and discussion, obviously. So the agenda here is to discuss, is it possible, you know, how viable is it? Can you get a 20% uncorrelated low volatility return? And what are the options? You know, we'll look at that overall topic. The agenda is sources of uncorrelated returns, what risk levels you actually face, the availability of those investments, attainable return levels, a comparative summary of where the Helpful Plus Merchant Bank Portfolio Fund, which Naif heads up, fits, expected returns in it in comparison to others, and investing via yourself, in an IRA, that's obvious too. But a couple of key points in the logistics here. Please post questions in the chat box. We will answer them either as we go or at the end, depending on the nature of them. If we can answer them in a value-added manner and in the order in which they're placed. Please do look at the please do look at the legal disclaimer, which furthers what I said earlier. We are not, actually, I haven't covered all of that. We are not a broker-dealer, Manhattan Street Capital, neither am I. We're not valuation professionals. We're not an investment advisory service. So I'm not here to recommend a particular investment. I'm here to shed light on this space and to help Naif shed light on his offering, but I am not recommending it because I'm not allowed to do so. That's the clear and important fact for you to know. And so we advise our clients to the extent the regulations allow us to. And we bring in all of the relevant service providers in order to maximize efficiency and minimize costs. And then we bird dog and project management and assist them through the entire journey. but we don't do the marketing. A separate agency does that. Broker-dealers do what they do, and we assist our clients in getting a broker-dealer where needed, et cetera, et cetera. Every different service provider we help with, but there are limits, a lot of limits as to what we can and cannot do. So without any further ado, let's discuss sources of uncorrelated returns. I made a list. I'll start talking to it, and then I'd like you to chip in, Naif, as you see fit. I've done a lot of hedge fund investing in the past. I can't say I've had fantastic success with that. I've had isolated cases of fantastic success. But generally, anyway, that's a source of high returns if you can get into a good one. Venture funds, the same thing. We'll get into the pros and cons and accessibility later, but just mentioning where are the places you can get uncorrelated returns if you look long enough term. Hedge funds, venture funds, early stage stocks, i.e. private stocks that have great potential because of the nature of what they are doing. Usually that's going to be a longer journey, obviously, but not always. Undervalued public stocks, crypto lending, which we'll get into, specialized lending, which is a very broad category, and frankly, which Naif's fund fits into because it's a form of specialized lending. So REITs, real estate funds, online investments and outside, junk bonds, all of these have different risk and return profiles, as you already know. But our intent here is to shed light on these options and in a comparative manner and add value to that discussion. So some of these are blatantly obvious, some of them are less so. P2P lending online, like Yield Street and Lending Tree and so forth. And I spent some time looking at rates available there. So Lending Tree and others, they are basically stating, yes, you can earn between 2.5% and 36% annual returns. But when you dig deeper, nobody's getting 36% returns. That space is flooded. There isn't much capacity available. And some of the funds have shut down their higher risk categories because of defaults and concerns going forward. So that is an interesting space. I am invested in that at a modest level in P2P lending. And actually, I'm going to be taking my money out because the returns are too low. That's the bottom line these days. What a surprise, let's face it, in this context. So without taking undue risk where I'm at, I can't get a decent return. So I'm taking, I don't have a huge allocation to it, but I'm taking my money out of that. So, Kiva is one of the best, and they are saying that it's a saturated market right now. And interestingly, there's a lot of players in this space. The last time I looked, there weren't as many. There's a lot of P2P lending platforms competing to assist you in getting a decent return. What I found is that Lending Club say that if you go with their highest risk lending projects, you can get an 11.7% return. So, that's not bad. Although, you'd have to diversify. And that's the thing that bugs me, because everything takes more time than I have. And I'm only in this lending fund that I'm in because I have a great friend who did that for me, because I don't have the time. I don't want to be putting $50 in this and $50 in that and $50 in the other thing in order to accumulate a diversified $10,000 portfolio. It was just, but he was kind enough to do that for me and has already got a lot of learning behind him. So Naif, please add value here in terms, or add value, pardon me. Please add your comments to this. Are there items that I've missed? And what comments would you like to put forward as to, some of these options that I've described?
Okay, yeah, well, first, thank you very much for having us as well. It's been great. It's been great working with you as long as we have. So thanks a lot, Rob. And thanks for everybody who's attending today, of course.
Yes.
But to dive right in, you hit on a couple of cylinders there. The market at large. I mean, that I feel like I could go on, quite some time about that. And I know we're sitting here with people who know their stuff about investing in the market, so to speak. So if we zero in a bit on the sector that we're in, which is primarily the merchant bank sector, then you really don't have too many places where you can actually allocate capital and get the returns that that we're looking at. To give you a couple of examples, really, you have companies like, just to throw a couple out there, and these, mind you, have a high degree of correlated risk with the market. You've got the likes of Square, for instance, the Cabbage, big names. Shopify has actually opened a department for strictly for lending to the small businesses that have their websites up on their platforms, and they're doing very well there, but they're not really opening up investments to the public that are direct investments the way that we're doing it. So it's investing in Stripe. If you're buying the stock or what have you, it's not a direct investment. It's investing in their company, which has many facets to it, and again, extremely
correlated.
correlated.
Can you, with Stripe, can you get into their lending activity direct without having to buy their shares, though?
As far as I understand it, there aren't, unless there's an investment firm that's doing something very, very nuanced and specific to their business, then no. Most of the others that are doing that sort of thing are, you have basically two segments there. You have larger wire firms like the Goldman Sachs of the world that are now breaking into this space. Which is great. Have a look at and see if there's anything available there. What you might find is that the returns are simply not the same. They have their costs. Frankly, they also have a bit of the volatility in association with the markets as well. I mean, it's a publicly traded company, and frankly, this isn't their focus either. So it's a facet of their business, but it isn't their forte the way it's been ours for this time. So that's one. You can choose the wirehouse route and maybe get a note or something to that effect. I think you're lucky if you.
Hey, Naif, I've got to ask you a question, and pardon me interrupting your flow, which I just did, but I know I did that. But it seems too good to be true, young man. I mean, on the surface, what you're doing, it seems to be too good to be true. Uncorrelated, low risk, 22%. Yeah, right. Get out of here. I don't believe it. I mean, I'm being a little bit of a pain, but shed light on that, because is it real? It does seem a bit of a stretch on the surface, doesn't it?
I've heard folks say that before, and I've addressed it the best that I can. The first thing is the lack of correlation. That's an easy one to answer, and it's simply that we're a company that has this focus. We don't have an underlying note or an investment vehicle that is attached to the market, that is attached to outside currencies, that is attached to anything that can fluctuate, that isn't directly tied to the core of the business, which is the merchant bank. So we have no concerns about if the market tanks or what have you. Conversely, if that is the case, and I don't want to take up too much time on a specific subject, but if that's the case, and we see a downtrend at large in the economy, you may see some defaults with the larger wirehouses. You're going to definitely see if the stock market's going down, and most of the stocks are going to, you're going to definitely see a depreciation if you're owning the public companies that are involved in the sector, just because you own the stock as well. So we don't have that direct risk, and quite frankly, if that's all going, if that's all happening with the economy, with the financial institutions, they're going to tighten up their lending. Mm-hmm. So if banks are then tightening up their lending, and small businesses are the first to not be able to access that type of capital for their needs. Well, I mean, I guess you know where I'm going with this, Rod. Where are they going to go next, right? The answer is the merchant banks. So while our business is the portfolios and our partners in the merchant banking sector, they're still growing very, very strong. If we see a downtrend in the economy and thus a lack of ability for these small businesses to get the capital from those banks, they're going to be bum rushing us. So it's actually, as far as I'm concerned, it's an inverse relationship with that volatility.
All right, so that doesn't cover the rate of return, though, right? What you said is it's uncorrelated, and you said it very nicely. But what about the return thing? It seems too good to be true.
Fair enough. So one thing that we pride ourselves in is our transparency. So we'll be able to demonstrate and show you what exactly we're doing and how. And the easy answer, and while we're all together and talking about it now, is I can just give you a quick hypothetical, right? So our merchant banks, hypothetically speaking, if we have a small business that is interested in, say, $100,000 funding, that could be over, let's say, the span of 60 days. So we have 60 days, that's the time frame. We have $100,000 that's out there. What we're talking about here, forgive me if I say the word lend, it's technically inaccurate. They go by factor rates, but I'll use percentages, and sometimes I might accidentally throw the word lending in there, but just so we can all.
Well, technically, it's not lending; it's called factoring. Okay, that's important for everybody to know from a regulatory standpoint, right?
Say again.
In the lending business, this isn't called lending, so we can't. If we say it's lending, we don't mean it. You don't mean it. You raise that for.
Yeah.
It's important to know.
So what we're talking about is that $100,000, and over the course of 60 days. Will be paid back, and we're talking about on a percentage basis. Let's just say on average, these types of funding deals are about 30% returns, right? So within that 60 days, you have your 30% return, and that's only 60 days. Now, of course, we have fees, we have the banking, the merchant banks in which we share in that profit and that income. So let's bring it down just a little bit from there, say. So if we have 30%, we're splitting it in half.
Well, you have other things. What about defaults? I suppose you're saying that the 30% gross is reduced by defaults. Must be, right? There must be some default.
Well, I'm using only one example for now. There are defaults, of course, as with any industry, and I can get into that as well. But if we're using the one example of XYZ small business, and they have a deal or loan funding deal in which it's $100,000 paid in 60 days. Our income then is the 30% that we're talking about. After we split it, let's say we're at 15-20% of income from that. That's again only 60 days.
Yep.
So then we're obviously not going to call it a day. Say we only we're gonna before the year is up, we're going to try to do that multiple times.
The recycle, yeah.
Precisely. So there's a bit of a compounding effect there. So the next time around, we're able to provide to people not the 100,000, but the 100,000 plus the amount of capital that we've generated from the previous deal.
So these are primarily loans secured by inventory or receivables?
Well, that can be, okay. So there are a few ways to skin that cat. There are supply chain financings that the companies do. We do diversify in types of in industry in the types of loans or funding deals. So yes, that can be one of them. We have well, there are, and again, so it's divided by the types of industry, the types of loans in of themselves, which I think we all know if anybody saw the deck as well. And we have, well, that's basically the.
So let me ask you a different. Let me just look at it a different way, right? Because what you're describing sounds like nirvana, 60% type returns in 30% returns in 60 days, and therefore you get to recycle it. So that's why Stripe and others are entering the space. Are they going to take all the attractive capacity away and squelch the merchant banks? I mean, I don't think that, if that's going to happen, I don't think it's going to happen in 3 weeks. I'm not saying that, but it's interesting because usually when you can get an unusually higher return, it doesn't last very long. because other people say, woohoo, and they jump on it, right? So where do we stand on that one? Is it very difficult to do this, therefore it's unattractive? Or, what is it that's holding everyone out? Everyone else who wants to make a big return from jumping into this space and doing exactly that.
That's a great point. One of the things I actually touched on just a little bit earlier, it's where this isn't the core of their business, right? Many of them haven't really been doing,
right.
So that's one aspect of it. And I'm sure, I'm not here to poo-poo anybody's the way that they do it, but it's probably fine. But the people with whom we're working these guys are experts in the space. They live and breathe the industry, and they've been doing it for some time, and their performance, speaks for itself. Mm-hmm. So we have that advantage, and I'm lucky to have.
So let me ask you this question, because I think this is highly relevant. What is the average return in this space? I mean, we're saying essentially, I think what you're saying is that you've got relationships with the best, and they're the ones that produce these unusually high returns. So I'm saying to you, then if I'm a giant bank with huge resources, and let's face it, at the moment, the giant entities have too much money and it's burning holes in their pockets. And I look at this category, what is the average kind of return, IRR, that the category is returning? Because that might be more relevant here as to whether it's going to get squelched or not.
Right. Well, this is where there is a further advantage to us versus the likes of the Shopify and the other folks.
Right.
Usually when they craft an instrument or when they have a deal out for investors, most of the time it's a very nuanced deal. For instance, X% on a supply chain management or supply chain deal. And then, or it's geo-specific, a Baltimore-based, lending deal for real estate or a mixed basket of things. So we have an advantage there in which it isn't that nuanced. It's not that specific, because we want to mitigate risk. And when you have risk, so that's one aspect of it.
Right.
The other is that it's diversified in the types of, so there isn't an easy answer. I can't just say, on average merchant banks can create, 50% returns on a yearly basis. Mm-hmm. It really depends on the type of portfolio that we're talking about. And right. Ours is mixed. So it's mixed in vis-a-vis the type of timeline that we're talking about.
Right.
Right. So we have that. We have the type of risk, right? So the riskier, just like, when somebody has the credit, if it's a little bit riskier, you're going to generate more returns.
Yeah.
So those are two big facets of it. And we have that mixed within the portfolios, underlying.
So I'm going to ask the same question in a different way. Give me your gut feeling for this category and tell me what you think the category performs as a whole in terms of annual rates of return.
Yeah, well, it's posted on our site. I mean, we feel very conservative with the 20%.
No, I don't mean that. I mean the category as a whole. If you ignore our specialty and our banks are select, et cetera, but I'm using your words because I'm not recommending your company, right? But I'm asking you this question. I know you don't know. It seems that you haven't got a precise number, which is fair enough. But what's your gut feeling? That's enough of a, you can give us your gut feeling. That'll be helpful. Is it 3.5%? You think, is it that low? Or do you think that in aggregate, this space is generating, what? Including all the players in it, because there's now, obviously we've got big players jumping in, as you mentioned. So what's it about, roughly? Because that helps me understand, and I think all of us understand, well, if the spectrum as a whole says that the average return for this type of activity is 8% net of risk, et cetera, then it isn't this glorious, exciting thing as a whole, where everyone else that hasn't jumped into it already is going to further compress it. But we're in a specialized sector because of your relationship with these funds that produce higher returns because they know better what they're doing or something, right?
Sure.
So give us an idea as to what the category is, please. And we can email people later and send them what it actually is. But if you could give us a sense now, that would be helpful.
Yeah, I mean, at large, the merchant banking sector can charge, to the effect of 20%.
So after fees and everything, after expenses and everything else, that might turn into 10% per year or 12% a year or something.
I was giving more of a net.
Net.
And again, I like to be conservative and then
Right.
exceed expectations.
This is remarkably unhelpful in my as an answer to my question. I hope you're noting that. But we will follow up. We'll send an email to everyone who is here and to those that said they would come because they're interested about that particular thing. I think that's really important, frankly, for the longer term, not in the short term, but in the longer term it matters, doesn't it?
Well, the short answer is the longer term in that space, they're seeing 80-100% returns. I mean, these are things with that compounding effect.
Yeah.
And again, that's gross. So I'm not.
All right. So now I'm sorry to interrupt you so many times, but now I have a different question. If our merchant bank activity, that we're funding through this effort, if they produce a better results, there's no cap on it, right? It's all going straight to the investors in the way that the fund states.
Yeah, well, right. We have a performance-based fee that we only accept if we outperform and generate enough to obviously get the principal back, and that's it. I mean, we're really.
There's no capping. There is no capping. We're saying these are high numbers, and there's no cap. So that's just to clarify, right?
Yeah. We right. Just as I'm trying to do, on our call here, we put down the expectations, and the idea is to exceed it. So that's the
hope. No, that's it. I want to change subjects now for a moment. This has been very helpful. Yeah. Hopefully it has to the audience. I found it helpful. So the one thing that I'm aware of is it to some people will be interesting. Yeah, right. I don't need to know about that. My anti-spyware program is already running. Well, thank you so much. There was a second instance there, so obviously I've got double coverage or something. Okay, so I want to talk a little bit about what is an interesting option to some people. Not 20% a year, but there's this business of, if you go to Coinbase, which is, I would say, a more conservative space for it, you can lend money via crypto. If you've got money in your Coinbase wallet, and they're talking 5% per annum, basically, that kind of rate, and you can get higher rates. I have a very good friend who is an amazingly sophisticated investor, and he was telling me about this. So his advice was to actually, let me see where I made either I have the notes here or it's on my phone. But the point is that it seems to me you can get 8%. About 8% is a doable number, maybe 9% currently. There's clearly risk if the entire crypto market was to crater, or if Ethereum and Bitcoin were to crater big time, then you can be sure that would turn into issues and problems, either lost principal or drastically lower returns. But in the current reality where that isn't happening, you're seeing lots of volatility. For the people here who like crypto, you can easily get 8 or 10%, 9%. And the thing which I want to pass on, because this guy I spoke with this morning is a true expert, and pull up the message, because I didn't write it down. Yeah, he had earlier recommended me to look at BlockFi, I think they're called. Yeah, that's the name. Yeah, BlockFi, but he is concerned about them now because they seem to be getting an undue level of attention from the regulators, which is not a good sign. Even if there's nothing wrong, they end up getting an undue level of attention from the regulators. That can be very punitive to the investors as well as the company. Mm-hmm. So just so you're aware, 8.5%, you can get that in this outfit in Canada called LEDN, literally lending, except it's all ass backwards in what the spelling is. So for those of you who find that attractive and are interested and okay with that level of volatility exposure, which is hard to pin down, I know a lot of people do that.
Yeah.
Not as attractive as your numbers on the face of it.
Well, I appreciate that. I mean, we're not saying that this is the end-all investment for everyone. We may not be for everyone, but we just take a look, and if you like it and it makes sense. And frankly, take a look at many other things if
Right.
that makes sense as well, just like, you know, you're pointing out. That's great.
So what I want to talk about in a moment is to touch on availability. You know, that's an interesting aspect. What is available actually versus theoretically when you go out in the market?
I'm sorry, can you repeat the question?
Well, yeah. So I mentioned hedge funds and venture funds. I'll touch on them right now because I've done a lot of that.
Sure.
And usually the minimum is $1 million to get in. And in venture funds, in the good ones, it's not just you got the money, you have to have the knowledge and relationship, which I have the good fortune to have actually. But you just can't go to a great venture fund and invest unless you have serious megabucks, you know, generally a minimum of $1 million. And then they'll consider it, you know, unless you're somebody that they know.
Yeah.
So it's not very available. That's my point. And it's long term. So yeah, I'm talking about, you know, in the framework of all these different ways that are on in uncorrelated investments, hedge funds and venture funds are such. Their availability, you don't just have to be accredited. In the case of many venture funds, you have to be qualified, which means a net worth of 8 million.
Yeah. Well, we do have to be accredited.
Yes.
Obviously with the Helpful Fund. So for starters. But yeah, I mean, we try. First of all, we understand that we're not any of the big names, the recognizable household names yet. You know, maybe we get there. Hopefully we do. But it's understandable if somebody wants to stick a toe in. So that's why we don't have like a really high entry point for others. We're talking about $10,000.
To get that name recognition, you're probably going to have to change the name of your company, in my personal opinion. But you've heard me say that.
Yeah, there's an email in there too that you might have sent about it.
Yeah, right.
Yeah.
So attainability of getting access, I mean, availability of access to it. This crypto stuff is easy access, easy in, easy out. If you like that, that's an interesting one in that way. Places like Lending Tree, you know, those better returns have a 3 to 5 year time horizon. So that's not easy in, easy out. I mean, it could be easy in a way, but it's not quick out.
Yeah. Probably worth mentioning as well. You know, provided with a little bit of notice, up to about 90 days, we have the ability to have withdrawals as well. So it's just with a little bit of notice. That's about it. So Can
you be more specific? Because that sounded too wishy-washy, to be honest with you.
Fair enough. No problem. So yeah, while we have a lockup period, we understand that things happen. I mean, obviously there's a pandemic going on, you know, that sort of thing. So if anybody wants to request an amount, a portion of their capital, even all of it, they send a formal request in. And upon, you know, we approve it, which isn't a long process. The manager, technically speaking, which is us. Yeah, and then you know, within the 90-day time frame, we're sending them their capital back. And the only reason why it takes that long, to some people that might seem like a long time, is because it's constantly at work.
Deployed, yeah. It's not sitting in a bank account waiting to be used.
Yes.
So I'm sure you wouldn't do that if there was a run on the bank that would kill the fund. You're doing that when the situation permits, right?
Yeah, of course. You know, it's for the benefit of everyone.
Yeah, no, that makes sense. Let me keep it balanced. Okay, so I was talking about all these other things. Early stage stocks, this is a good time. I mean, valuations are higher everywhere, which is less true with very early stage investing. Most of that, I mean, this is a space that I know really, really well because I've been on both sides of the table and I'm doing that right now. You know, we're raising money for the Manhattan Street Venture Lending Fund. And there are some amazing companies I want to invest in. But setting that aside, most early stage companies are going to take 6 to 8 years realistically to get to the point that they can scale up, kick ass, and become really attractive and maybe list, go public. There are exceptions, but these overnight successes usually do not occur. Actually, they usually take a long time to prepare. Big returns, illiquid until they're liquid, and that might be never. I've done a lot of that, and I've had some terrible returns, and I've had some fantastic ones that make up for it, you know. But that's, you know, availability, yeah, not too hard to find them, especially online these days, right? There's lots of online investments to be had on our platform and on others. Undervalued public stocks, that's a good place to go. It just takes work and a bit of luck or picking a manager to do it. And then you're not really liquid if you find out that you want to sell, but they went down another 20%. So you are liquid actually, but it takes work, doesn't it? So it's a selectivity thing. Big returns possible, and you have significant capital risk.
I started out on Wall Street being a retail broker, and you know, this was when online trading was kind of just getting its legs, so to speak. And to your point, Rod, it's a lot of work. I was doing most of the work, you know, and it's a full-time job, finger on the pulse of the economy and everything. It's a living, breathing thing. Sometimes I just didn't understand how, you know, say a doctor from, you know, Wisconsin or something has a practice, a busy one, and they're sitting there trading or you know, I just don't know how they can do both things. So, or even identifying some of the opportunities that are out there. I mean, it's literally the job of certain folks, and formerly myself. And I don't know how you're doing anything other than that if you're really going to isolate something extraordinary. So
yeah,
you know, I get what you're saying there.
Yeah. So yeah, liquidity, availability, risk. You know, these are different puppies that it's all a matter of preference, right? It's all a matter of preference. What I found in hedge fund and venture, different thing in venture investing. What I found in hedge fund investing is there were two problems that I experienced too much of. One was crooks, literally crooks. And the other was stupidity, in my view, where, you know, they had a strategy and I bought into the bloody strategy, and then they zipped off and did something else, levered, that killed it, right? And by the way, Lending Tree uses 2-to-1 leverage. Interesting point. No, hold on. No, one of the crypto places uses 2-to-1 leverage. That's the point. Leverage is the killer, right? If you're invested in something and you know, and it goes down a bit, if you're not levered, that's one thing. But if you're levered, then margin calls or whatever it is. And I was too heavily invested in a hedge fund some long time ago. Well, just in early 2007, before the housing crisis. And the hedge fund manager, which had a great strategy, suddenly decided that mortgage-backed real estate, residential real estate, was a good place to be, levered. So he put a large portion of the fund to work in a thing that wasn't supposed to be, but he was technically allowed to do. And I would never have invested a penny if I thought he was going to put money in residential real estate, you know, 2 years earlier when I invested. But he lost everything, wiped out the entire fund, because of course it was the exact wrong time to be doing that. Yeah. So yeah, you know, liquidity, availability, volatility, it's hard to find uncorrelated investments that produce decent returns in this market. You know, I actually think, I'm going to digress, I think that you should modify your offering page to touch on this issue. I think most people looking at it are going to think it's too good to be true. You're going to have to put some evidence in there or address that question, because the more I think about it, having spent a bit of time revising and researching in preparation for this webinar, it's screaming great returns if it's true. And I'm not meaning to recommend, because I'm not allowed to do that. I'm saying you got a problem here, which is it sounds too good to be true. That's what I'm saying. I think you need to address that.
Transparency, I think, is really going to set us free here. You know, just to be able to demonstrate.
You need to show the actual returns as they occur.
Well, yes, we have an obligation to, you know,
But that gets in the way of raising the money first, right? Raising the money first is easier if people who say, yeah, right, it's too good to be true, and then just disappear.
Right.
That's what I'm saying. I think you've got to address that issue somehow, maybe with a short video clip or something, because I don't know, I'd be really fascinated to interview everyone in the audience here, but I bet you know, coming in, they were thinking, yeah, right. You know, how's that going to be real? Because it's a sort of it just seems to be too good to be true. So, yeah.
Well, it's something that you're talking about. Some of the wealthiest guys in finance have not been talking about openly. It's a very niche area, merchant banking. And frankly, you know, I don't know, maybe there are people out there that are not thrilled that I'm doing what we're doing here, because I feel like I'm letting a secret out, you know.
Yes.
This is it.
Yeah.
Until you see some of the things that we've talked about earlier with the, you know, with the yield streets and what have you, but as far as it being a very direct investment with the returns, without somebody else, you know, putting a hand or two into the pot, and then, you know, it's not out there. So,
Right. So
yeah, I'm open, by the way, to anybody, if, you know, if it's whomever it is out there that wants to write a note. Our email is right there. I'm happy to speak with anybody. We've gotten that before, where it's like, you know, how is this real or what have you? Well, it's our job. I feel like it's just as much our job to demonstrate, to show, and to discuss exactly how and why it is. Because
yeah, I think it's better to head that off on the offering page right up there, because there's a lot of people who, if they have that question, will look at it and then disappear and never come back, and they're not going to be available because that's all she wrote. You know, yeah. I think you should up front address that.
Sure.
Doing it after the fact isn't going to be as effective.
Fair enough.
Yeah, yeah. I'd like to ask if there are questions from the audience. There aren't lots already, so that either means it's boring what we've said, or we've covered the ground with incredible efficiency, which would be a first. For me anyway, not for you, Naif. I'm sure you're really good with your webinars. But any questions, please post them now. Comments, suggestions, welcome too. But we are, you know, we're 45 minutes. This is a cool time to start winding down if there aren't questions. I think we've covered the ground as we promised. I don't think there's anything we've missed out, really, is there? Is there something you need to say that you didn't say?
I think we got blanketed most of the high level stuff. Maybe
right.
A little more, hopefully.
Was there a special offer thing you had or not that's current? I don't remember
that. You know, after this webinar, you mean?
Yeah. Well, no, at the webinar that's current now. That has to be no, because you would be aware of that, right?
Yeah, no. We've had a heck of a response so far. You know, really, we just want to start some new conversations with some new, you know, new clientele and yep. Get the word out, so to speak. So that's our objective.
Yeah. Yeah. Okay. So I think thank you very much. I'm going to move towards closing here. We recorded this session. We will be sending a recording out to everyone who attended and those who intended to attend. And what we'll do with that, it'll be a link which will take you to a blog post on the Manhattan Street Capital site, which will be indexed. So you can click on the interesting bits and ignore the boring bits or the bits you already know, right? Otherwise, it would be a bit of a long journey. So that's what we'll be sending out. It'll take about a week. Upfront fees. What are, oh, here we go. There's a couple of questions. I'll go to the top of the list of them. Oh, that's actually it. What are the upfront fees?
Yeah, we charge 6% upfront. Pretty cut and dry.
Yep. Okay.
And all of our estimates are inclusive of that. So it's not.
If somebody has to redeem in 6 months in, do they get any portion of the upfront fee back, or is it gone?
No, we're not.
Not refunding.
It's atypical that anybody redeems early, especially when we're demonstrating what we are. Right. But if we do, and we don't penalize either. Just
right, which is good. Yeah, that's good. It's in the real estate, in the online real estate investing offerings, many of them penalize investors that want to exit early, and that's understandable. But also, I don't like it. I feel like they should make it more friendly, frankly.
Yeah. I could see if it was a situation where, they offered liquidity with a penalty, but you get your capital back in, a couple of days, but with the ability to have the time to liquidate our positions and what have you, and within that 90 days, then that doesn't incur any real.
There's no penalty. Well, that's good. That's good. Okay, good. So that's what we will send out that email link, as it were, as I said. Thank you, everyone, for joining us today. I hope that this has been helpful to you. I hope get helpful. I hope that it's been useful to you. And thank you, Naif, for being here and being direct and candid as you always are. And Akos, thank you for putting it all together. Really appreciate your work. I enjoyed doing this. Hopefully you enjoyed it too. And talk to you all at the next one. Have a good day.
Thank you, everyone.